Okay, so imagine you build this massive, highly profitable engine selling compounded weight loss drugs. Then you get regulatory cold feet, torch the whole supply chain for a $33 million write-down, and pivot entirely to branded Wegovy. That is exactly what HIMS and HERS just did. Welcome to Earnings Unscripted. Today is May 11th, 2026, and we are unpacking Q1 2026 for HIMS, ticker HIMS.
Yeah, it is honestly a structural earthquake for them. You look at the headline revenue, $608.1 million, up 4% year over year. So that looks stable, but underneath that, they basically blew up their own gross margins on purpose.
Just casually blowing up the business model. Quick thing before we tear into those margins. This podcast is just our personal opinions, definitely not financial advice. But Miro, the tape on this one, it had a rough quarter already. Stock was down around 43%. What happened after hours today?
Steady, unrelenting selling. They were actually flat during the regular session today. Then the bell rings, the numbers drop, and shares just bleed out over 11%, falling straight down near $25. The market saw a $92.1 million net loss and panicked.
Well, right, earnings per share came in at a loss of 40 cents. A year ago, they were positive 20 cents. So that is a huge whiplash. But the paradox here is the consumer demand is just insane right now. They shipped over 125,000 orders of Wegovy in just 6 weeks. Management basically said the app traffic blew past their wildest New Year's or Super Bowl spikes.
No, but that is exactly the problem. Demand is fine. The unit economics are breaking. They are swapping out those high-margin compounded treatments for lower-margin branded pills. Gross margins fell straight down to 65%, down from 73% a year ago. And a massive chunk of that is just from eating that $33 million restructuring hit on their old compounded supply chain. It is facing total obsolescence now.
Right. It feels like they are just paying a very heavy cash toll to get right with regulators. Actually, wait, we have to touch on their international segment, too, because the U.S. revenue might be under pressure, but outside the U.S., it was up, something crazy?
969%. It hit $78.2 million for the quarter, nearly a 10x expansion year over year.
Wow. Okay, yes. Let us get into the details on where all that growth is coming from and what this weight loss pivot actually means for them.
It basically comes down to buying revenue and dodging jail time, honestly.
Okay, that is a strong thesis. Start with the dodging jail time part because we definitely need to unpack the actual motivation behind that $33 million write-down.
Right. Management officially calls it a strategic shift, but if you dig into the risk factors from the 10K back in February, the General Counsel for Health and Human Services literally went on Twitter and announced they referred HIMS to the DOJ for potential Title 18 violations.
Wait, Title 18? That is actual criminal liability. It is not just your standard FDA warning letter.
Exactly. It is a structural threat. They spent $31 million back in 2024 just to buy Metasaurus RX, which was the core of their compounding facility. Now they're just accepting that it might be totally obsolete. And Andrew Dudum, the CEO, had a fascinating spin on this.
I mean, they kind of had to spin it, right?
True. He was talking about why they are pausing other compounded drugs like peptides. Let me just pull the exact wording here. Yeah, he said the current gray market is unregulated, inconsistent in quality, and that they will not launch until they meet very high standards.
Which is a little rich considering they were profiting from a version of that gray market just last quarter.
Yeah, it's funny how the moral high ground usually appears right when the feds show up.
Exactly. But okay, jokes aside, it is a smart de-risking move. It protects their medical brand long term, but it also means they have to find margins somewhere else since selling someone else's branded Wegovy pill doesn't exactly print cash like their in-house compounding did.
It absolutely does not, which brings us to the real deep dive here. The $150 million cash they quietly dropped on your bio in January.
Right. The microneedle company.
Yes, so they are vertically integrating capillary blood testing. Basically, it is
Well, it is a pain-free way to draw your own blood at home. Then they feed all that biomarker data into what they were calling Labs AI.
I loved reading about this in the transcript, actually, because it moves them away from just being the discrete pill provider, like, coming to them just for hair loss. The app can proactively scan your blood results and tell you your testosterone is crashing before you even feel the fatigue.
It is brilliant ecosystem capture. It shifts the whole business model from reactive to preventative longevity. And the CTO, Mo El-Shinawi, was pounding the table on this. He pointed out they support tens of millions of touch points with human providers correcting the AI inputs. He called it, quote, the highest quality label in AI any company can hope for.
And you can't just buy that kind of human-verified data loop. Plus, it makes the platform incredibly sticky. If they're monitoring your literal blood chemistry every month, you are not canceling that subscription.
Right, you are locked in. But they're paying a very steep price for all this stickiness and global reach. We talked about international growth getting up almost 10 times year over year.
The Eucalyptus acquisition, which is just a massive swing.
A $1.15 billion swing. It gives them Australia, Japan, Germany, the UK. But here's the structural catch. It's $240 million upfront, $710 million in deferred payments, and HIMS negotiated the option to pay up to 60% of those earnouts in stock.
Oh, boy. So if you're a retail investor holding the bag, you're basically staring down the barrel of massive forward dilution through 2029 just to fund this empire building.
More or less, yeah. The CFO pitched it as preserving balance sheet flexibility, which is undeniably true for the corporation. But if I'm a shareholder, I'm wondering how much of my equity is being used as a corporate credit card.
It's such a fascinating puzzle. They're torching their old compounding cash cow, stepping away from the DOJ crosshairs, buying the globe on an installment plan, and pivoting into proactive AI health monitoring. So where does this leave their actual trajectory heading into next quarter?
It leaves them asking the market for a massive amount of patience. Look, the Q2 guidance on the top line is decent. They are projecting up to $700 million in revenue, which is roughly 25% growth. But profitability is where you see the strain. Adjusted EBITDA is only expected to hit roughly 5 to 8% margins next quarter.
Which is incredibly thin considering they just told everyone they are building a global health empire. And wait, didn't they actually raise the full year guidance, though, up to almost $3 billion?
They did, yeah. And that is exactly the catch. The CFO told analysts on the call, quote, "We expect a meaningful step up in adjusted EBITDA dollars in the third and fourth quarters." So they're setting up this classic hockey stick projection.
Right. The old, I promise the profits are coming in the fall maneuver.
Pretty much. They are assuming these massive cohorts of Wegovy patients will just compound and naturally drive down marketing costs. If those subscribers stick around, the cash really does flow back. If they don't, well, that is where the dilution risk really kicks in. Because if that Q3 profit jump fails, they will not have the cash to fund that billion-dollar Eucalyptus buyout we talked about.
Exactly. So retail investors just end up footing the bill. We talked last quarter about how they were suddenly dealing with heavy corporate physics with their supply chain. It feels like now they're just trying to outrun gravity entirely.
That is a fair way to put it. Though honestly, to be completely fair to management, if this AI lab testing loop works out and international holds, their long-term target of $6.5 billion in revenue by 2030 is actually viable. Credit where it is due, it is a brilliantly aggressive vision.
It really is a multi-billion-dollar bet on proactive health, all while the DOJ is breathing down their neck. But what a puzzle for investors to figure out in the meantime. I think we have tortured these numbers enough for today, right?
I think we have, yeah.
All right, let's wrap it up right there. Thanks for hanging out with us, everyone. We'll catch you on the next one.
See you next time.
Just a quick final note, if you want to catch these earnings drops as soon as they happen, following the podcast is probably the easiest way. Earnings Unscripted is put together with the help of AI, which is exactly how we turn giant stacks of complex filings into a real conversation you can actually listen to. Let us know what tickers you want us to unpack next by shooting an email over to earningsunscripted@datamadness.ca or just grab the X link down in the show notes.
Thanks for listening.